Don't put all your eggs in one basket. For some of us who don't really have much money to begin with, how can we diversify? So this video is going to give you some of the ideas that I know of where you can diversify if you don't really have much money to begin with. Let's dive into it. So one of the options that you can pick is called an exchange traded fund, or ETF in short. So what is an ETF? The name kind of explains what it is. It's a fund that is traded on an exchange, which is a stock market basically. So how you buy an ETF is that it's similar to how you buy stocks. You just go to your broker and search for the ETF ticker symbol, then you just press buy, and that's it. So if buying an ETF is like buying a stock, then how are ETFs different from a stock? The thing about ETFs is that with a smaller amount of money, you can buy more shares, indirectly of course. ETFs generally have a theme. There are funds where they specifically invest in, say, the S&P 500. There are ETFs that specifically say invest in the China market. There are ETFs that specifically say I invest in the Singapore market. There are ETFs that are sector specific as well. Like you have ETFs for healthcare, you have ETFs just for tech, you have ETFs just for financials. So ETFs have a lot of options for you to choose from. You need to know what ETFs you are buying. So you can go Google and search for what ETFs that you want to buy depending on what stocks you want to buy. So for example, if you want to invest in the top 500 companies in the US, you can search for an S&P 500 ETF. So you have different options out there. You have IVV, you have SPY, you have VOO. So all of these are very similar. It's just they are managed by different companies. If you want a sector specific ETF, like for example, I have a semiconductor ETF, SMH, or I have a medical devices specific ETF, IHI. So every one of these funds, they will have their own website. So you can go into their website and you can have a look at what are the key holdings of this fund. So if you look at SMH, for example, you can see the largest shareholdings are Nvidia, Taiwan Semiconductor, and Broadcom. And you're buying at a fraction of a price. So if you're buying SMH for $140 and Nvidia is around 20% of its price, so you're kind of like buying Nvidia at $28 rather than its own share price of $400 plus at recording time. So that's the good thing about ETF. You can buy more shares indirectly with smaller capital. But the catch is that ETFs will have small proportion of shares that you don't want. Like if I go to the lowest end of the page, I can see like Universal Display Corp, Corvo, Teradyne, Skyworks Solution. I have no idea what the hell are these. But I don't care, I just want the biggest share, Nvidia and Taiwan Semiconductor. Another downside of an ETF is that your ETF will always underperform the original share. So I have plotted out the top 5 shares within SMH and SMH itself on a 10-year time frame. If you're looking at the chart, you can see that Nvidia is up almost 10,000% over the past 10 years. AMD is up 2,000%, Broadcom is up over 1,000%, ASML near 700%. SMH itself is only 570%, but it outperformed TSM, which is only up 300%. So generally, your ETF will underperform most of its largest holdings because its price is weighed down by the losers. Right, so in this case, for example, will be TSM, and the smaller ones that you don't want, they will kind of drag down the ETF's performance. Then of course, ETFs have something called an expense ratio, which is kind of like the annual management fee. Generally, I would say this is not significant as long as it's below 1%, which most ETFs are, then it's pretty good to go. Because 1% or below is actually insignificant when something like SMH can grow over 500% over 10 years. So what is 1% over 10 years is only 10%. So it's not significant, but it's something to consider as well if you want to diversify through ETFs. If you don't want to go down on the ETF route, there's another option where you can buy lesser shares than original. So in US market, for example, some brokers do offer something called fractional shares, where you can literally buy less than 1 unit of a share. You can buy 0.1, 0.05, you can buy 0.5 of a share. So you can have a lower entry price, so you can buy more shares. So if you're looking to buy Nvidia, for example, if you only have a budget of say $100 for Nvidia, then you can buy 0.2 units of Nvidia. So yeah, that can be done if the broker offers it. If you're looking at certain Asian markets like Malaysia, Singapore, Hong Kong markets, for example, usually you will buy in what's called a bought lot, where you need to buy at least 100 shares of a company. So certain companies are really expensive if you need to buy 100. If you want to buy say Tencent, which is around 300 Hong Kong dollars, so if you need to buy 100 of it, that is gonna be 30,000 Hong Kong dollars. It's a big chunk of money. If you are looking to buy say DBS Bank, so DBS current price is around $33. If you want to buy 100 units of DBS, that is gonna cost you 3,000 Singapore dollars. Also a big chunk of money. Do you know that you can actually buy less than 100? You need to use what's called an odd lot. So with odd lot, you are buying units of shares. You can buy say 5 units of Tencent, you can buy only 10 units of DBS Bank. So depending on what is your appetite. The downside towards fractional shares and buying odd lots is that liquidity could be a problem. So if you are buying say 10 units of DBS, you might not get matched easily, or it wouldn't be at your favorite price. And if you're buying say a fractional share, you want to buy half of say Nvidia, you might not get the price that you want. For my example, I'm using Moomoo. So if I want to buy fractional shares, I need to buy using market price. I cannot decide the price. And another problem is that if you're buying only such a little, you are gonna have a problem with transaction costs. Because for most of the time, some transaction costs are fixed in nature. For my Moomoo example, if I buy a US share, I'm going to incur 99 US cents fixed on my purchase. If I buy a Singapore share, it's gonna cost me say $2 of commission already, fixed rate regardless of how much I buy. If I buy 100 shares, if I buy 10 shares, they'll also be the same price. So it's gonna be harder for you to break even if you buy lesser units of shares. If you want to diversify with low capital, these are kind of like the two options that you can go for, the ETF route or the lesser unit route, I would call it. So both have its pros and cons, so you need to be aware of both to know which route you want to go. Personally, I do diversify using both ways as well. In the ETF route, I have SMH, I have IHI, I have XLG, I have XLV, I have XLF, different types of ETFs, which I kind of think of getting rid of them in the future. And I also have some where I buy through fractional shares. Like for example, I have half a unit of Adobe, I have half a Meta, I have 1.5 for S&P Global, different companies. So certain companies are not that accessible through the ETF route. For example, I can't really find any ETF that has Adobe as its largest proportion of holdings. So that's why I choose the fractional share route. I would say that if you don't have much money to begin with, don't diversify too much. And good luck with diversifying your portfolio.